Understanding Bollinger Bands. Bollinger Bands are a popular technical analysis tool used to visualize price volatility and potential turning points in the market. In this lesson, you'll learn how these bands form a dynamic range around price and what their movement reveals about market conditions. Bollinger Bands help traders measure market volatility and spot price reversals. By visualizing the price range, they assess if an asset is overbought or oversold, aiding trading decisions. Before we dive in, let's quickly recap the key components of Bollinger Bands. Knowledge check. Bollinger Bands components. Match each component of Bollinger Bands with what it represents. Traders choose a 20-day SMA. Now that we've reviewed the key components, let's explore how Bollinger Bands help traders make informed decisions. Traders choose a 20-day SMA because it matches a typical month of trading, which allows traders to capture a short-term trend without being overly reactive to daily volatility. The 20-day SMA reflects the near-term trend, acting as a baseline for price movement. The SMA serves as the center line around which the upper and lower bands are drawn. The upper and lower bands are placed 2 standard deviations above and below it, respectively. Standard deviations help identify the range of typical price fluctuations based on the recent price history. When the price nears the upper band, it could signal an overbought market, suggesting a potential pullback. On the other hand, when the price approaches the lower band, it may indicate an oversold condition, presenting a potential buying opportunity. When the price is near the 20-day SMA, it suggests a neutral market. In this case, traders typically wait for confirmation of a breakout. Time for a quick quiz. Look at the chart for the USD-JPY pair. The price has just touched the upper Bollinger Band and is showing an upward momentum. Based on this chart, what is the best course? Yes, you're right. Exactly. The price touching the upper Bollinger Band suggests an overbought condition, making it a good opportunity to sell or take profits, anticipating a short-term pullback. Always confirm with other indicators for a more reliable decision. Nevertheless, keep in mind that Bollinger Bands are secondary indicators, meaning they should not be used in isolation. While they measure volatility and identify potential reversals, combining them with primary indicators like trend lines, RSI, or MACD helps confirm signals and improve accuracy. For example, combining Bollinger Bands with the Relative Strength Index, RSI, provides a powerful confirmation tool. If the price touches the lower Bollinger Band and the RSI shows oversold conditions below 30, it signals a potential buying opportunity. Conversely, if the price reaches the upper band and the RSI indicates overbought conditions above 70, it suggests a possible selling point. Time for a quick quiz. Look at the chart for the USD-EUR pair. The price is approaching the upper Bollinger Band and the RSI is approaching the overbought level. Based on this chart, what should you consider doing? Hold, waiting for confirmation of the trend. Sell, anticipating a price pullback or reversal. Buy, expecting the price to continue rising. Enter a short position. No, the correct answer was sell, anticipating a price pullback or reversal. Incorrect. When the price touches the upper Bollinger Band and the RSI is above 70, it indicates an overbought condition, suggesting that the market may be due for a pullback or reversal. This is a common signal for traders to sell or take profits, anticipating a short-term correction before the trend continues. We've covered the basics of Bollinger Bands, how to use them to identify overbought and oversold conditions, and how combining them with indicators like RSI can enhance trading decisions. Next, we'll explore squeeze patterns and breakouts, focusing on identifying low volatility and breakout opportunities. Let's learn more about Bollinger Bands. In this lesson, you'll uncover how Bollinger Bands can help you spot squeeze patterns, signaling upcoming breakouts. By the end, you'll be able to identify these key moments when the market is about to make a big move and trade with confidence. Let's focus on the squeeze pattern, which occurs when the Bollinger Bands tighten, meaning the distance between the upper and lower bands contracts. This narrowing happens when price volatility decreases, signaling that the market is in a period of consolidation. The price action tends to slow down, moving within a relatively tight range, as neither buyers nor sellers are dominating the market. In this phase, market participants are uncertain about the direction of the price, and the volatility typically drops to its lowest point. The contraction of the Bollinger Bands indicates reduced market movement. This often signals a period of low volatility. It can happen after a strong price move, as the market takes a breather. It may also occur when traders are waiting for important news or economic data. Traders often see this as a sign that the market is building pressure. This pressure often results in a breakout once the market picks a direction, which could be either up or down. If you see a squeeze pattern, it's not a big deal, and you don't need to pay much attention to it. Yes, you're right. A squeeze pattern should not be ignored. It often signals a buildup of pressure and is typically followed by a significant price move, either up or down. The breakout direction often follows the prior trend. If the market was rising before the squeeze, an upward breakout is more likely. If it was falling, a downward breakout is more probable. Traders also pay attention to key support and resistance levels. A squeeze near resistance might result in an upward breakout, while a squeeze near support could signal a downward breakout. Volume also matters. A breakout with high volume shows strong market interest and is more likely to continue. A breakout with low volume may lack support, increasing the risk of a false move. Additional indicators like the RSI can help confirm the direction. An RSI above 70 suggests an overbought market, potentially indicating a downward breakout, while an RSI below 30 signals an oversold market, suggesting an upward breakout. Knowledge check. Identify signals of a bearish breakout. Select the 3 signs that suggest a bearish breakout. Excellent. Remember that traders usually enter a trade once a breakout is confirmed by volume and additional indicators like RSI or MACD. They exit when the breakout fails or if the price begins to reverse after the initial move, 2. But be careful. False breakouts can be spotted when the price moves beyond key levels, support, resistance, or Bollinger Bands, but fails to sustain the move. Common signs include weak volume, quick price reversal, or no confirmation from other indicators like RSI or MACD. Time for a quick quiz. Look at the chart for Starbucks. The price is approaching the lower Bollinger Band, and the RSI is below 30. What should you consider doing in this situation? Buy, expecting the price to reverse and move upward. No, the correct answer was buy, expecting the price to reverse and move upward. Oops! When the price touches the lower Bollinger Band and the RSI is below 30, it indicates an oversold market, suggesting a potential buying opportunity. The price may reverse toward the middle band but always confirm with additional indicators to avoid false signals. In this lesson, we covered how Bollinger Bands help identify squeeze patterns and breakouts. Next, we'll explore how Bollinger Bands can be used in different markets, focusing on range-bound versus trending market applications. Bollinger Bands in different markets. In this lesson, you will learn how to apply Bollinger Bands in different market conditions, specifically in range-bound markets and trending markets. By the end of the lesson, you'll understand how to adapt your trading strategy to each market type using the Bollinger Bands to identify key opportunities for entry and exit. Let's check your knowledge. A ranging market occurs when the price moves consistently in one direction, forming a clear uptrend or downtrend. No, the correct answer is false. A ranging market is characterized by the price bouncing between support and resistance levels, moving sideways and not forming a clear trend. Nice. A range-bound market moves between support and resistance without a clear trend. Bollinger Bands help in these conditions by acting as dynamic support and resistance levels. Because the bands expand and contract with volatility, they naturally wrap around price action, mirroring the support and resistance levels. When the price reaches or nears the upper band, it acts like a resistance line. It may be considered overbought, and traders expect it might soon fall. When the price touches or nears the lower band, it acts like a support line. The market may be oversold, and a price bounce upward is likely. Traders take advantage of this predictable behavior by either buying near the lower band, expecting the price to rise, or selling near the upper band, expecting the price to fall. Remember, this strategy works best in non-trending markets. Always confirm that the market is range-bound. Otherwise, you risk entering just before a breakout, when the price starts trending strongly in one direction. To reduce false signals, many traders also combine Bollinger Bands with confirmation indicators such as RSI or volume. Time for a quick quiz. Look at the chart for Bank of America BAC. The price has recently touched the upper Bollinger Band after a steady climb. Based on this chart and the position near the upper Bollinger Band, what would be a reasonable next step? Buy, expecting... Yes, you're right. Good job. The price is testing the upper Bollinger Band, which often acts as dynamic resistance. Unless confirmed by strong momentum or a breakout pattern, this may be a signal to take profits or prepare for a potential pullback. Always confirm with other indicators before committing. While you can trade the highs and lows of the range, the market won't stay there forever. A breakout eventually ends the range and starts a trend. How can you predict if a breakout is coming? You already know the answer. Watch for the signs of a squeeze. When the Bollinger Bands tighten and the market quiets down, it's often a signal that a big move is on the way. A quick check. In a trending market, the price consistently moves in one direction, either upward, uptrend, or downward, downtrend, without returning to previous levels. Yes, you're right. That's true. In a trending market, the price moves in one direction, up or down. Bollinger Bands are particularly helpful in trending markets because they expand with volatility and adapt to the price movement, giving traders real-time guidance on trend strength and potential pullbacks. In an uptrend, the price often rides along the upper Bollinger Band, showing strength and momentum. Traders look for buying opportunities near the middle band or lower band, expecting the trend to resume. In a downtrend, the price tends to hug the lower Bollinger Band, signaling sustained selling pressure. Traders look to sell when the price pulls back to the upper or middle band, anticipating a continuation downward. In an uptrend, the lower and middle bands act as support, while in a downtrend, they become resistance. Traders use these pullbacks to enter in the direction of the trend. Knowledge check. Match trade actions. Match each market condition with the appropriate action based on Bollinger Band behavior. Bollinger Bands work even better when combined with momentum indicators like RSI or MACD. These tools help filter out false signals and confirm the strength of a trend. Whether you're trading in a range or a trend, proper risk management is essential. Breakouts can fail, trends can reverse, and ranges can expand. That's why setting stop-loss orders just outside key Bollinger Band levels is a smart way to protect your capital. Time for a quick quiz. Look at this Bank of America chart. The price has recently moved above the middle Bollinger Band, volume has increased, and RSI is nearing 55. Based on the Bollinger Band's volume and RSI, what would be the most reasonable trading decision right now? Enter a buy trade, expecting the breakout to continue. Wait for the price to close above the upper Bollinger Band with higher volume. Sell immediately, expecting a reversal from resistance. Short the market based on the RSI being near 55. Yes, you're right. Great job! While the move above the middle band with rising volume and RSI near 55 is promising, it's safer to wait for a confirmed breakout above the upper band. Entering too early could lead to a false signal. In this lesson, you've learned how to apply Bollinger Bands effectively in both range-bound and trending markets, identify entry points, confirm breakouts, and manage risk. You're now ready to put your knowledge to the test. Next is a short quiz to reinforce what you've learned.
What does it mean when the price touches the upper Bollinger Band in a range-bound market? It means the price will stay flat. It suggests that volatility is decreasing. It confirms a strong breakout is starting. It may signal overbought conditions and a possible pullback. What is the best tactic when the price touches the lower Bollinger Band and RSI is below 30? Look for a potential buy signal, confirming with other indicators. Avoid trading until the RSI reaches 70. Sell to exit before a breakdown. Enter a short position immediately. Amazing. 2. What does a Bollinger Band squeeze indicate? That the price will reverse sharply. That RSI is overbought. An immediate trend continuation. A buildup of pressure that often leads to a breakout. 3. In a squeeze scenario, what makes a breakout more reliable? A contraction of RSI. A histogram crossover. A volume surge accompanying the breakout. Flat movement along the middle band. What combination suggests a strong bearish breakout? Price bouncing at support. RSI below 30. RSI above 70. Squeeze near resistance. And breakout with volume. Histogram shrinking and RSI at 50. Middle band breakout with no volume. When price rides the upper band in a strong uptrend, what tactic is recommended? Wait for a complete squeeze. Buy on pullbacks to the middle or lower band. Sell immediately when the price touches the upper band. Trade only if RSI drops below 30. What does a range-bound Bollinger Band setup suggest to a trader? Always wait for the MACD to cross. Buy near the lower band. Sell near the upper band. Avoid all trades until RSI reaches 50. Trade in the direction of the last breakout. What's a smart move when Bollinger Bands contract and the price nears a key resistance level? Ignore Bollinger Bands in resistance zones. Sell before volume rises. Immediately enter a short position. Watch for a potential breakout to the upside, but wait for confirmation. What should a trader do to manage risk during breakout trading with Bollinger Bands? Use stop-loss orders just outside the breakout level. Ignore volume confirmation. Only rely on Bollinger Bands without confirmation. Enter with full capital during the squeeze. 2. What role does the middle Bollinger Band play in both uptrends and downtrends? It replaces the need for volume analysis. It often acts as a support in uptrends and resistance in downtrends. It signals trend exhaustion. It triggers entry without confirmation. Amazing.